So you're in discussions to sell your company and your lawyer says you better check with your insurance broker to see if there's anything you need to do other than cancel your policies after the closing. Just about then, alarm bells should be going off. For many privately held mid-market businesses, there's much more to do than just cancel your policies after the closing. In this video, we're going to talk about just one element of your insurance and what needs to be done when you're selling your company. That issue was, what do you do with your D&O policy? To start off, let's quickly run down why D&O should be such a focus at the time of a transaction. First, D&O protects the company's decision makers for wrongful acts committed during their tenure as a company leader. Lawsuits which arise from those wrongful acts often name the decision maker personally, which puts their personal assets at risk. So D&O is there to protect the decision maker's personal assets. Next, the D&O policy is written on a claims-made policy form, which means there's some unique issues that need to be considered, which we'll jump into in just a second. Lastly, during a transaction period, from the initial discussions through diligence and all the way to closing, the buyers are relying on the seller's statements and representations, which could give rise to D&O-related lawsuits down the road. So what's the rub? In most D&O and other management liability policies, there's something called a change in control provision. This section of the policy says that when a majority control of the insured entity is sold, merged, or otherwise changed, the policy is terminated and the policy is put into runoff. At first, this may not seem like a big deal. You were going to cancel that policy anyway, right? Well, as mentioned earlier, the D&O policy is written on a claims-made policy form, which means that for a claim to be covered, the claim must be made or presented to the insurer when a policy is either in effect or in its extended reporting period, commonly called a tail. Because the policy terminates at the transaction date, you'll need to purchase an extended reporting period or tail in order to have coverage for acts which occurred before the transaction but were not reported until sometime after the transaction date. D&O and other management policy claims usually don't get reported until well after the act was committed. Now, the reason you need to think about this before the transaction is that you want to include the cost of your extended reporting period into your negotiations. The cost of an extended tail can be anywhere from 75% to 300% of your annual premium, depending on the insurer and the duration of the tail. Premiums on tails are due in full upon binding, so that can represent a good chunk of money. Finally, if management is staying on post-close, they will need to purchase a new D&O policy for the new entity. I suggest engaging your broker early on in the merger discussions and allow at least 4 weeks prior to the transaction to give your broker time to negotiate the best terms and conditions the market can offer on the new D&O policy and arrange for your tail or extended reporting period to have a seamless transition. Have questions regarding D&O or other issues in a merger or acquisition? Give me a call. I'd be happy to chat with you about it, and my contact info is coming up. Thanks.